Hello friends, welcome to this investment banking tutorial from WallStreetMojo. Let us now move forward and look at another important function of an investment bank, and that is helping companies raise capital. And capital could be of different forms. It could be through an equity dilution or it could be through loans. So investment banks actually do both. Well, before going deep into these options, let's try to understand what is raising capital and how investment banks help companies raise capital. As you can see, there are various companies that would be in need of cash to grow. It could be related to certain set of projects, or maybe, they may want to kind of expand their reach from national to maybe international platforms. So raising capital by corporates is one of the key activities that they perform. So they may approach a bank like the regular bank for different credit-based loans, but they may approach investment banks for a special set of needs. So what are those set of needs? Let's kind of understand while exploring its functions. When we talk about companies wanting to raise funds from the market, there would be an intermediary that we will call here as investment banks. So what the investment bank does is that it matches the investors on one side with the companies on the other side. And basically what happens is once they match, the advisory fees or the commissions are actually taken by the investment bank. And that is why investment banking salaries are really, really high. Let's say if you have done a deal of raising capital to an extent of, say, $100 million, the advisory fee of an investment bank can be 2%, 3%, or 4%, and that could really mean big number. So this is a profitable business as the advisory fees helps them earn a lot. As I said earlier, companies looking for capital hire investment banks as they have certain advantages associated with it. First is that even if the institutional investor is in New York, currently maybe operating in Singapore or anywhere globally across Hong Kong, Sydney, or maybe London, investment banks have key network access to these investors who may be interested in certain set of securities or investments in certain companies. Secondly, they are experts in valuations. So let's say if the company wants to raise capital, they may want to share their own set of equity, right? So what is the price at which they can share their equity? That comes from investment bank. Thirdly, these banks play a very important role in negotiating between the parties involved. So think of buyers and sellers. So they come as negotiators in between. In addition, they also bring in their own experience along because they help ensure all the regulatory compliances associated with it as well. So just to give you an example, when a company would raise funds from the public, there would be certain set of procedures that needs to be followed or the regulatory aspects that needs to be looked at, right? Will the company be able to do it on their own with the limited staff? It will be kind of very difficult, and that's number one. And secondly, they may not be equipped with the right skill sets to actually go to the market all alone. So in most cases, in fact, in almost every case, you'll find that investment bank represents the company when they go to the market. So capital raising and going to the market can essentially be done in many different ways. Say the first one, which is again very important, is issuing of new securities. One example could be that of Facebook, issued its IPO for the first time in May 2021 as it wanted to raise capital for growth, and it did that, right? Likewise, Twitter had launched its IPO in NYSE in November 2013 with the same objective, which it successfully achieved, and in fact, it later withdrew as well in 2022. The tech giant is expected to hit the stock exchange with a new set of securities by 2026, again to expand its horizons even more than before. So that's what, issuing a new securities would mean. And these issuing of securities is represented by various investment banks. So it could be JP Morgan, Morgan Stanley, just to name a few. Second could be raising capital by issuing bonds. The reason could be various set of expansions that the companies may be looking at, or the aim could be to finance certain set of projects. Obviously, the reasons could be many, and investment bankers here appear as the best medium for representing these things to the market. So now that you have understood how investment banks help companies raise capital, it's time to discover how it is done. So as you know that one of the ways of raising capital is through equity dilution, right? So let's now look at IPOs and FPOs in a bit more detail. So let us now look at the meaning of what exactly the investment banks do when we talk about IPOs and follow-on IPOs. So when we look at IPOs, we are essentially saying that there's a private company or a privately held company. And let's say there are only limited number of shareholders who have actually started the firm. And let's call them as founders. Now, when a private company grows big, obviously they would or they may require funds to kind of finance their growth. There can be different tools associated with financing their growth. It could be that the bank may be ready to kind of lend the appropriate amount of money. If the bank is probably not in a position to lend it because the company is maybe too risky for the time being, private companies can still consider going to the market. Now, what does this mean? In the private companies which are closely held, it means 100% of the shareholding is between the founders and the initial set of investors. Now these founders and the initial set of investors are now willing to share their stake in the company with the outside investors in exchange of capital. So what do we understand by outside investors? Outside investors are general public investors like you and me, or maybe other institutional investors. So if that happens, we can say that the private company has gone public because they have shared their shareholdings with others like you and me. So this is where investment bankers come into picture. And the shares of this public company is basically then given to the public. So this share may depend on how much dilution this company would be looking at. So it could be 25%, 30%, 35%, and it will also depend on the amount of funds that they want to raise. Now, this brings us to another important question. Why an IPO is actually required? Is it required for growth? Is it required for acquisition? And what role do investment banks actually play here? They take care of the regulatory aspects, they find out valuations, they help in preparing prospectuses, and they also know the procedures, right? They know how to comply with the Security and Exchange Commissions, follow their rules and regulations, and all in all, they ensure that the IPO is successful. What do you mean by IPO being successful? IPO being successful means that the IPO was fully subscribed. If there is no investor interested in it, obviously IPO will not be successful. And that brings us to another important role of an investment banker, which is to basically spread awareness about the IPOs. Investors are kind of made aware of such an IPO, and investment bankers urge them to invest in that. So investment bankers work a lot on the IPOs, and they charge a certain percentage of the amount that is raised. So it can be really big at times for these investment banks in terms of commissions or the advisory fees. Now that the concept of IPO is clear, let's now look at what is a follow-on IPO. A follow-on IPO is just another set of stock offerings by the company which is already public. So say for example, there's a company who has already gone public and has shared around 25% of its equity with the public. Now they want to raise further funds, and they don't want it to do it through the traditional loan or banking where where the debt is raised. So instead, they want to share the equity with the public. So earlier 25% was shared, now they want to share another 15%. This extra offering is the follow-on offering that may go public as a FPO. Again, an extra number of shares will be issued to the public. Here the public would know at what price these shares would come and what is the market price, right? And how would these follow-on IPOs are being valued at. So all of these information are very critically available, and investment banks help a lot again here to make the FPO a success. So with this, we have understood that the IPO leads to equity dilution, which means that the investors are normal retail investors. It could be public like you and me, or it could be institutional investors as well. But there is another category through which equity dilution can happen, and where companies may not want to actually go to public. And this is called as private placements. Here you are just diluting your equity and raising capital through select investors. So what do these private placements mean? Here the companies actually sell their securities only to a small number of investors not to general public like you and me, but maybe to a bank, maybe to mutual fund or institutional investors or an insurance company. This means that the small number of investors may invest large amount of funds to own their company, maybe 10%, 10%, 10% each, and make it a private placement. So this is yet another option towards raising capital. Here again, what an investment bank does is that they connect these institutional investors to companies and help them achieve their goal of raising capital through private placement opportunity window. Now you may be wondering, why would a company even look at private placements? So they could be due to certain reasons. The company may not be very big, or they may not have an appetite for an IPO. And not to forget, IPO comes with a lot of pros and cons. One of them being the downside is that if you list it, then you're answerable to more number of shareholders in terms of at least the absolute number. And you are then in the purview of SEC as well. And then you may have to make regular quarterly filings, minimum number of disclosures, and all these regulatory aspects are to be taken care of. Many companies, however, don't want that hassle and hence opt for private placements instead of preferring to go public. So that's about it for the reasons why private placements. And with this, we hope you have understood how investment banks actually help companies raise capital. Stay tuned for the next video of the series on underwriting and market making functions of an investment bank.
Conclude today's discussion. A big thank you to everyone who tuned in from the Wall Street Mojo team. But hold on, the financial adventure continues. The next episode unfolds on Tuesday, and we're super excited about what's in store. Make sure to subscribe and turn on those notifications so you don't miss out on the financial insights coming your way. Until next time, this is the Wall Street Mojo team signing off. Stay informed, stay engaged, and stay Wall Street Mojo awesome.